Oh, what's going on, everybody? Hello, good afternoon. I'm gonna go ahead and get started. Today is Wednesday, so I'm doing another crash course on real estate based on questions that I get from people. Hopefully, it'll be helpful for somebody to shed some light to some of these things. Hope you guys are having a great day. Um, Middle of the week, so we got a little bit more to go. So let's finish the week strong. Let's go. So today's masterclass is going to be about the question, what makes a property a good deal? Like, how do I know what I'm looking at is a good deal? There are several different ways to look, more than dozens, if not maybe 100 different data points you can look at. When it comes to that, there's only so much information you can know up front. But before I get too far ahead, I want to actually go into a Bible verse. I think that there's a lot of Bible verses and references when it comes to real estate that are still applicable. There's a lot of real estate deals that happen in the Bible when you really think about it. So anyway, Proverbs 24 and 3. It says, by wisdom a house is built, and through understanding it is established. Through knowledge, its rooms are filled with rare and beautiful treasures. I really want to focus in on the part that says, by wisdom a house is built. Because it definitely takes wisdom. In real estate specifically, the wisdom shows up in numbers, timing, paperwork, and strategy. It's not in emotions. Typically, when emotions get involved, that's not a good thing. Or more so just means you're not seeing the deal as clearly as it can be seen. Also, price matters. Don't get me wrong, but you don't want to look at real estate based off of prices that you're comfortable with. So anyway, I'll jump right into it. Here are 10 core filters that make a good deal when it comes to real estate. So the first one is the most important one, and it's more about a principle, but you always want to see things from the end and then reverse engineer to the beginning where you are. So, can you refinance it? Can you sell it? Can you rent it? What opportunities exist for you to pivot if your exit strategy doesn't go as planned? Do you have a backup just in case something happens? Like, for example, we had the shutdown with COVID. That changed everything overnight for a lot of people in terms of, materials, labor, all the above, demand. So what do you do in a situation like that when you're in the middle of a project? So you want to understand your exit strategy, and you want to be clear on what that exit strategy is, and you want to try, if you can, to have more than one exit strategy, just in case your preferred exit strategy, for whatever reason, closes up. We got tariffs right now. So it's affecting a lot of things. I don't know if you guys have been on Amazon or Temu or any of that stuff recently, but shipping is more than a lot of the things that you're actually buying right now. So you are ready to pivot and go in another direction if you have to. The main exit strategies for real estate is to refinance and hold. That means you don't sell it, you just pull your money out. Rent it, which is similar to, I guess, kind of you're still holding, but you're getting that income, so you can kind of combine some of these. You can also sell it. I personally think that selling is the last resort, depending on your strategy. So you have to understand whether you want short-term income or you're looking for long-term income. If you're trying to flip some money in within a year, then a flip obviously is the best. If you're looking to supplement your income, maybe you're retiring or getting close to retiring, then you can rent something out. You can do something a little different. You can look for the long-term play. But ultimately find out what it is that your goals are, your income goals, and then reverse engineer into where you're starting from. So it's pretty simple, but you always want to think from the end and then keep that end in mind, and don't deviate too much unless you have to, based on your plan Bs and everything like that. Okay, so the second one is cash flow or flip profit. I've kind of touched on that a little bit, but it's more about, do you want monthly returns, or do you want a big lump sum at the end? Or do you want a combination? Some deals come with a combination of that. You're really looking for, we kind of went over cap rate a little bit yesterday. Cap rate basically is the return on investment that you'll make if you bought a property cash. So, $1 million property with saying that it has a 3% cap rate would mean that, you would make 3% on your $1 million if you just wired $1 million to them and bought the property. Most people are not doing that. They're getting loans, so there's some more math that goes into that. But that's a quick way to kind of break down what cap rate is. So you're looking for a strong cap rate. Cap rates change based on the type of property you're buying. So you got to check your markets. Every market is different. It's very dynamic in that way. But you want to look for strong returns. Whatever market you're in, you're looking for at least the returns that the market in that area gives. You don't want to get lower returns, because what would be the point of that? You're also looking for, on a flip, you're really looking for, I'd say, a minimum of about 20% profit margin on a flip. And most lenders are going to hold you to that anyway, in terms of what they allow, what they'll lend on. They're going to put you through the underwriting process and all those procedures, and they're going to make sure that your deal has enough profit in it to make sense for you to move forward on. If you're buying cash, it can be a little bit more risky in terms of not having someone else to look over your deal unless you get somebody to do that. But that's the great thing about having a lender. The lender actually is your partner. They want you to succeed because they want to be paid back. So getting a loan on deals can help out with things like that. But let's go ahead and go to number 3, the purchase price. So not necessarily, you can buy real estate. Real estate can cost as much as hundreds and billions of dollars. It has a very high price tag potential. Even the cheapest real estate is, 6 figures most of the time. So it's not necessary. Don't let that mess with you, like the numbers. I know most people, like, in the world, don't make that much annually. So it can be confusing, or it can be scary, I guess I would say. But don't allow it to be. Those are just the numbers. But you do want to make sure that you're not buying above the market price, or what the market price should be. That typically is going to flesh out in an appraisal or some type of inspection or something like that, to where you have someone else, third party, go in, look at it, and tell you what the value of it is. Single family, multifamily. I don't know too many deals that don't close without some type of appraisal. So you'll know what that is typically before you close, because you won't even get a clear to close until you have the appraisal, and they'll let you know, this is the price that this property came back as far as its value, and you'll be able to look at the price that you had it for under contract and see if you're in a good position or not. The lender will let you know. Once again, the lender is your partner. So on to the next one. Strong location. Location. Everybody's heard that part. Location. So I think that's pretty straightforward. I mean, you're looking for jobs, you're looking for schools, you're looking for transportation, you're looking for population growth, and you're looking for strong trends in the direction of those things. And you're also looking for the trends in the direction of those things leaving. One area that we look at is U-Hauls. U-Hauls tell a lot about a market as far as what's going on, the rentals, people getting them to go out of the state or out of the city, or are they coming in? A lot of them from out of the state coming in. So there's a lot of different information that you can get from to find out whether your location is strong. But jobs, schools, infrastructure, the government the city, whatever area that you're buying in, is very important too. To know, like, I guess, kind of how they're handling their cities. For example, you look at something like Chicago. I hear a lot of bad things about the Chicago government, so maybe you think twice about owning property there. I don't know. I haven't done any deals in Chicago, but I hear bad things about the government and them being over budget and XYZ. So you want to think about the services that come with the government that you're purchasing property in, and make sure that it, is something that works for you. Another one, or the next filter, is zoning flexibility, and I paired this also with value add potential. They're kind of different, but I say they go hand in hand right now. Zoning flexibility is very important. Your property is only as valuable as what it can be zoned for. There's something called highest and best use of a property, meaning that if it's zoned for multifamily, but you have a house on it, you're not using it for the highest and best use, because you could put apartment complex on there, and the value will be much higher. Now, you don't have to, use it for the highest and best use. I'm actually dealing with the client that has a house on a multifamily property, and in my head, I'm just like, man, why don't we just build some apartments and make some real money here? But he wants to build like a little shed. It's his property, so he can do what he wants to do. So either way, though, zoning flexibility is important, because even though he's building the shed now, in the future, maybe 10, 20, 30, 40, 50 years from now, he decides to knock that down and build the apartment complex, he can. So it's important to have flexibility with your zoning if you can. I always purchase properties, or try to, that have the zoning and the entitlements already in place, so I don't have to rezone or go ask for anything. I'm looking for properties that already have that in place, so that I have flexibility and value add potential. That's basically just where you go in and do something to the property that increases the value of it, like a flip. A flip is a good example of that. You buy a messed up house, or old house, whatever, it needs updating. You do some work to it, and then now it's worth more. That's value add. You just added value, literally. So you want to look for properties where you can add value, and doing work on a property isn't the only way to add value. For example, if you are able to rezone a property from single family to multifamily, or anything, to something where you have more density, which is more units you can put on it, then you're gonna increase the value of that property. As soon as that approval is given, your property is now worth more. So there's a lot of different ways to add value to a property. So I won't go through all of them here, but the next filter is subsidy and grant eligibility. There's so many different programs available for real estate development and acquisition. One of the biggest ones is LIHTC. That stands for Low Income Housing Tax Credit. So, and that's it's a tax credit. It's kind of complex. I won't go too deep into it. It's administered by the IRS, but it's the biggest provider of affordable housing in the country. So it's a very big subsidy that exists, and they basically put the equity in, and you're able to get the project done like that. There's also home funds. Home funds come directly from HUD. There's CDBG, which stands for Community Development Block Grant. Yep, that's what it's called. And then Section 8, there's project-based Section 8, where you get vouchers, but the vouchers are on the property, meaning that each unit has the voucher. So if somebody moves in, they're under the voucher, but when they move out, they lose the voucher, and the next person that moves in now can benefit from that voucher. So the voucher stays with the unit. And then they have tenant-based rental assistance, where the voucher goes with the tenant wherever they go. So, and that's most of what you hear of. You don't hear a lot about the project-based vouchers, but a lot happens there as well. So that goes back to the subsidy and grant eligibility. The Federal Home Loan Bank has a grant program that they do every year for real estate. I think it's up to $1 million that they'll put into your deal now. I mean, you have to go through a whole application process and all of that. My overall point is all these programs have criteria that you have to meet in order to qualify for the funding. A lot of times it's about the location that you're in. Typically, they want you to be in distressed areas that they want to see more development in, opportunity zones, difficult to develop areas, things like that. It's ways that that's how they incentivize development in areas that they want it to be incentivized in. They want to see more building. So you want to check to see what type of funding a deal can qualify for, because honestly, some deals can be funded without any investors, meaning that it could just be you, the loan that you get from the bank, and hypothetically you get a grant from HUD. You don't need any investors. They're the investor. So that's something to consider when people are thinking about getting into real estate and how can they afford it? How can they raise money? Grants and subsidies are a great way to do it. City of Atlanta has a lot of funding mechanisms for this type of stuff. So anyway, I'll go to the next one. I could talk about that all day. The next one is you want to get favorable financing and or leverage. So basically that's your loan, that's your debt. You want to make sure that you have the best debt possible, the best loan possible on your real estate. and you get different terms based on the real estate. So you can give a lender one property and they come back with these terms and this rate. You give them another property, maybe it's in a different area. There isn't redlining is illegal now, but they do it now through crime statistics. So if you have high crime statistics in an area, they'll be less likely to lend to you, or if they do, it will come with excessive fees and excessive interest rates and things like that. So you want to make sure you're getting favorable financing. That's very important. There's some tricks to getting favorable financing. For example, partnering with the city on a project, or the county. The city and the county get the best rates from financing. As you can see why. They're the city, they're the county. So they have a lot of track record, a lot of they can get good financing. So if you partner with them, you can benefit from that. Another one is to if you work with a nonprofit. Nonprofits get really good terms and rates and things like that as well. So depending on what type of project you're doing, you could partner with the city, you could partner with a nonprofit, or you can just work with somebody who's very, very experienced, has a whole bunch of experience and track record. You bring them in as a partner and you benefit from their track record. That gets you lower interest rates and a little bit more consideration from a lender. But the goal, honestly, is to try to get either seller financing or a combination. You're trying to get the lowest interest rate possible. You're trying to defer payments if you can, if it makes sense for your business model. And you're also trying to get interest only payments if that makes sense as well, because that brings your payment down and increases your cash flow. And you're also not trying to put a lot of money out of your pocket. Like you're trying to get as much of this deal financed by the bank or others if you can, as you can. I know you guys have heard of other people's money, OPM. That's the way that this country was built. That's the way this country continues to grow. The government borrows trillions of dollars. So don't feel any type of way about borrowing money in this current climate or economy. That's kind of how things go. That's the rules. That's the law of the land. The other thing that you want to look at is tenant demand. You want to make sure that whatever it is that you're buying, you have tenant demand. Will it sell or will it rent fast? Like when you're done doing whatever you're doing to it or closing, when you turn around and list it, will people even be interested? I'm also working with a client now. They have a property on the outskirts of Athens, which is not a major market, and they flipped it. They're now working on staging it. It's been listed for a long time and it hasn't sold because there isn't a demand for this product. Like there isn't a demand for this house, at least at the price point that he has it at. So you want to make sure that somebody's even going to be interested. There's a lot of ways to do this. For example, in new construction and in resale as well. If you're doing a flip, list it before you're done. Like list it while it's still being done. Like a lot of people do that with new construction. You might just see a lot and it's for sale, and they're saying, "Hey, envision this house. Like this is what the house will look like. Do you want to buy this at this price?" You actually get better financing as well if you do pre-sell your property before you're done or before you even start working on it, which is possible. If you look on Zillow now, you'll see plenty of listings that don't have any pictures of the property because it doesn't exist yet, but they're pre-selling it. So nothing's wrong with pre-selling or pre-renting or pre-leasing. That's a part of the game so that you understand the demand before you get too deep into it. You may have to make some adjustments depending on what's going on. Another filter is your rehab risk and the known repairs. The less you know about repairs, the lower you need to offer, because you need to make up for that, like that gray area. You need a lot of cushion there. You want to know as much as possible. The best way to go about doing this is to get an inspection. You get an engineer or you get a commercial inspector, somebody other than yourself, to look at the property from a third party point of view and tell you, hey, this needs to be done, and this is how much that costs, this is how much that costs, this is how much that costs. And I'm not saying use that as like rule, because they can come in under as well, like in terms of what it actually costs when you start bidding that stuff out. But it's a good place to get an understanding of what your rehab is. A lot of people want to bring in a GC to do it, which is cool to kind of get an idea. Or what I think you need to do that, but keep in mind the GC is just trying to get business most of the time. So you want to be careful with that. at least using their number as law. And the same thing with the appraiser. At the end of the day, there's always going to be information that you don't know. You can't know everything. You're just trying to know as much as possible within the time that you have for due diligence, which it can be done. You just have to be very diligent in how you go about your due diligence. And the last one I would say is alignment with your strategy. I touched on this on the first one, but it's very important that you understand what it is that you're trying to do. If you're trying to make some money within 30 days, I can tell you that wholesaling is probably the best way for you to go. 30 to 60 days. You're not going to buy an apartment complex or an office building and flip it, that quickly. It's just kind of hard for that to happen due to everything that has to happen during the process of closing. But if your idea is to make money over the long term, maybe you're okay with the 5 to 10 year payout, but it's going to be millions, like it's something impactful. Then you have a different strategy. So really define what your strategy is. Strategies can change. This may be your strategy for 2025. Your strategy may change for 2026, but you need to define what your strategy is. And I'll share right now. My strategy right now is, I would say I probably have about a year and a half timeline on projects that I'm working on. I am looking longer than that, or looking to start looking longer than that. But right now, I'm working on deals that return back some capital or start giving me cash flow at least within about 12 months to 18 months. But that's because I'm doing major rehabs on things. I'm doing major rehabs. Sometimes it's as much as gutting the whole thing down to the studs and then going back and doing some things. And that takes time, especially on multifamily properties, anywhere between 100 to 400 units. It could take some time. But there's a big payoff at the end, or the payoff, it starts paying out cash flow monthly. Once you finish that work, once you get it leased up, then it starts paying a lot of cash flow. So that's kind of where I am. I'd love to hear more about where you guys might be, or where your strategy is. Like, what would be your goals if you got into real estate today, or if you're already in real estate? What are your goals personally for you? Like, do you want to make money quickly? I know that everybody wants to make money quickly, but how quickly? What is quickly? 30 days for wholesaling. I'd say 90 to 180 days for a flip. For a new construction, I'd say 9 to 18 months for new construction, to go from buying a lot to building it. Depends on permitting and all that stuff. Multifamily, it can happen pretty quickly in multifamily, just depending on what your goal is. You can buy a nice piece of property that's already cash flowing, and you can start getting those cash flow payments, the rent payments, that next month. It won't be a big payout, but it'll be a drip. It'll be something that you get every month. So figure out what your strategies are, what your strategy is for yourself, what you would like to earn in real estate, and then kind of reverse engineer from there. But anyway, that's what I have. If you have any questions or anything like that, please let me know. I'm here to help. If this information was valuable to you, please like, comment, subscribe, share. I'll be on here doing a video every week similar to this about something real estate related. My goal is to help inspire 1 million real estate developers. There's a lot of development that needs to happen. I was fortunate enough to end up in this space by way of mentors and hustle. And I think that it needs to be demystified so that more people can get involved and do great things in real estate. It's the best industry in existence. It's the best asset out there. I'll debate with anybody on that. I don't care about Bitcoin. I don't care about currency. I don't care about precious metals. I don't care about any of that. Real estate is the main asset in existence and has been for I don't know how long. So that's something that you need to know. And something that I think that everybody should get involved with. So I won't continue to talk you guys' ears off. I appreciate you checking me out. You got my information and stuff. Reach out to me if you need anything, and I'll catch you guys on the next video.